Okay, so let's start with the SEBI ICDR regulations 2018. Yes, as you can see from the heading, other regulations, that is the SAST regulations and PIT regulations, prohibition of insider trading and substantial acquisition of shares and takeover regulations. This we have already covered before. The last one that is left for us now, that is your ICDR regulations 2018. First of all, ma'am, what is the full form of ICDR? So ICDR stands for issue of capital. Okay, issue of share capital, issue of capital and disclosure requirements. You can see it here on the board, issue of capital and disclosure requirements 2008. I hope I'm clear till here. Can we get into the chapter now? Yes. Now, first of all, what is the purpose? Okay, what is the purpose of the SEBI ICDR regulation? So basically, in India, we all know that we have got capital markets. Okay, we have got stock markets. So it is one of the regulation which is going to regulate and develop the growth of our capital markets, and it is also going to balance the interest of investors. Okay, investors, that is people like us, and issuer companies, the companies which issue their share capital, and the people who are going to invest in that. It is going to balance the interest of the both. That is the main purpose of your SEBI ICDR regulations. Mainly for our syllabus, we have got two things covered here. One is some things about IPO and some things about FPO. We have got an overview of the same. Okay, we are restricting it. Okay, we are restricting the provisions which is required for our examination purpose. Okay, otherwise it is going to be, it can be, it is too less to be done. So we are just going to restrict it to the thing that is there for our SPOM examinations. Before we start with it, there are a few terms which we need to just discuss at once. You must be already knowing it, but we need to discuss it once. Now, when we talk about a public issue, okay, what do you mean by the term public issue? Public issue is whenever we are coming up with a public offer. Okay, either it can be my first public offer, my initial public offer, IPO, or it can be my FPO, further public offer. Okay, now what is the difference between IPO and FPO? So IPO means whenever the securities are offered by an unlisted company. Okay, whenever securities are offered by an unlisted issuer to the public. First time, till now it was unlisted. Now it is offering securities to the public. So that is called as IPO. Are you clear with this? And when will we call it as FPO? You are already a listed entity. Okay, you are already a listed issuer and then you are offering the shares to the public. Then it will be called as FPO. I hope I am clear till here. Yes. Then another two terms which you must have already heard before, that is rights issue and bonus issue. Right? Rights issue. What do you mean by rights issue? When a listed company is offering shares to its existing shareholders. To its existing shareholders, not to general public, but to its existing shareholders, that will be called as rights issue. And similarly, bonus issue. Okay. Now, bonus issue means what? Bonus issue means when the shares are offered to an existing shareholder, but for free. Okay, but for free, that will be called as bonus issue. Right shares were given at some discounted price to the existing shareholders, whereas bonus shares are given for free. Are you clear with this? Yes. Okay. Then there is another new term coming up called as composite issue. What do you mean by the term composite issue? Composite issue is nothing but public issue cum rights issue. Means you are offering some shares to the general public also, plus you are doing some rights issue also, that is to the existing shareholders. So obviously it is done by whom? It is done by a listed issuer. Okay, it is done by a listed issuer. And what type of issue is done? It is issuing some shares to the public also, and it is issuing some shares to its existing shareholders also in form of rights. Such an issue is called as a composite issue. Very clear with this? Yes. And last term that we need to understand here is your private placement. Okay, what do you mean by the term private placement? Private placement is whenever we are issuing some shares or whenever we are issuing some convertible securities to a selected group of persons. Okay, to a selected group of persons not exceeding 50. This limit can be raised and this can go up to 200. But as of now, just remember, you are issuing your securities to a selected group of persons not exceeding 50, or 50 can be cut and it can be returned as 200 in a financial year. In a financial year, then such type of issue of securities will be called as private placement. Okay, means you are not offering it to the general public, you are offering to a selected, you have chosen, the company has chosen the selected group of persons, and to them we are issuing the securities. Generally this is of two types. One is something called as preferential issue, and second one is something called as qualified institutional placement. Okay, or you must have heard about QIBs, qualified institutional buyers. If we issue the shares to qualified institutional buyers on a private placement basis, big buyers, but on private placement basis, then it will be called as private placement. Are you clear with this? Yes, so that was the meaning of the term private placement. Few more terms are going to come up in between. We will do it as and when required. Now, these regulations, okay, this ICDR regulations will be applicable to whom? So it will apply to your IPO, it will apply to rights issue, it will apply to bonus issue, it will apply to further public offer, it will apply to IPOs by SME companies. Nowadays you must have heard about IPOs by SME companies also. Then it also applies to listing on IGP. I had mentioned about IGP in the previous regulations, Innovators Growth Platform for Startups, etc. So for all these things, the ICDR regulations will be applicable. Are you clear with this? Okay. Now getting into the main provisions. If for the purpose of our syllabus, we have got provisions relating to IPO and provisions relating to FPO. Okay, these two things are there now, IPO and FPO. Now what I have done is I have made some short notes, okay, so that you can refer it for your examination purpose, because otherwise so much to be done becomes a little hectic. So just try to understand from here, everyone. Only two things, okay? IPO provisions you have to understand. If you are able to understand the IPO provisions properly, 80% of the provisions are same for FPO. So FPO is going to be a very small part. The only big thing that we have to do here is the IPO. Yes, okay. Now IPO, you already know, IPO stands for initial public offer. Yes, where an unlisted company is coming up for the first time with a public offer, that is called as IPO. Now in our regulations, they have given us what are the requirements. Okay, whenever someone is coming up with IPO, what is the requirement, which company can come up with the IPO, how the prices are decided, for how many days the issue will be kept open, what is the procedure, and all those things we have to do here. Okay, so now whatever conditions we are going to study here, okay, whatever conditions we are going to study here in the regulations, those are to be fulfilled. Whatever conditions we are going to study, those are required to be fulfilled on the date of filing the draft offer document. Draft, you must have heard about prospectus, red herring prospectus somewhere in your intermediate law, etc. Yes, so can we say that is nothing but your draft offer document and the offer document? So that you have to file it to the SEBI, and you have to also file it to the ROC. This we have already studied in our Companies Act before. So whenever you are filing that draft offer document and final offer document to the SEBI and to the ROC, as on that day, you have to make sure that you are also complying with the SEBI ICDR regulations 2018. Okay, that is written there. Then next they are telling who is totally debarred, okay, who is totally restricted, who is not eligible to make an IPO. So they have given two categories of conditions here. Now for mainly can we say, if an unlisted company is coming up with a public offer, then the people responsible to bring that offer is going to be the promoters, directors of the company, etc. So they should be good persons, okay, they should be clean persons. Now see, just check the left hand side, what is written there. If the issuer, promoter, directors are debarred, are restricted from the capital market, okay, if they are totally restricted from the capital markets, then in that case, boss, your company cannot bring an IPO. Okay, because they must have done some default because of which they are debarred from the capital markets. Yes. Then the next one, promoter or director of the issuer is a promoter or director of any other company that is debarred. Let's say we have got some promoters or directors who are also a promoter or director or of some other company, and that other company is debarred. Okay, not my company's promoters or directors, but the other company in which they are acting as a promoter or director, that company is debarred from accessing the capital markets. Are you clear with this? Yes. So in that case, our company is not eligible to come up with an IPO. Okay, if you really want to come up with an IPO, then you'll have to remove your existing promoters and directors from the company, right? Then next one, issuer company or the promoters or directors, if they are willful defaulter. Okay, if they are willful defaulter, means they are declared as willful defaulter, or they are fraudulent borrower. They have done some borrowings in which they have done some sort of fraud. There is a fraud in repayment of that borrowings, etc. Right? And the last one, promoter or director is a fugitive economic offender. Fugitive economic offender. I don't know if you know or not, but Mr. Vijay Mallya, Mr. Nirav Modi, etc. These people were declared as fugitive economic offender. So if they are the promoters or directors of a particular company, then that company cannot come with an IPO. Are you clear with this? Yes. So basically here, any defaulting people cannot come up with an IPO, or defaulting people working for a particular issuer company, that issuer company cannot come up with an IPO. Very clear with this? And similarly, if there are any outstanding convertible securities, suppose if you had already issued some convertible debentures which were going to get converted into equity shares, unlisted equity shares possible, but your company has not done the conversion, then the company itself is a defaulting company, then the company cannot come up with an IPO. Are you clear with this? Yes, so basic condition. First, by default, they are telling that if you fall under so and so categories, then please do not even ask us. Okay, please do not even ask us that can we come up with an IPO? You need not even go and check for the other conditions. Right? Then next one is an important answer. Okay, next one is an important answer. Eligibility requirements for IPO. Okay, now if you do not fall above, means you are eligible. Okay, means you are eligible. Then now you can think of coming up with an IPO. If you want to come up with an IPO, can we say it is a very important thing, because now your company is going to deal with public's money, right? So there are certain conditions. Okay, there are certain conditions which are required to be fulfilled. Now, either you have to fulfill this one, this sub-regulation 1, or you have to fulfill this sub-regulation number 2. Okay, to be very specific, let me tell you, this is regulation number 6 and this 6.1, and the right hand side is regulation number 6.2. Okay, 6.1 and 6.2. So first you have to try to fulfill your regulation number 6.1. If 6.1 is not possible, then even if you fulfill 6.2, that is okay. Okay, now for 6.1, see what are the conditions. Your net tangible assets, okay, issuer companies, net tangible assets should be of at least rupees 3 crore. Okay, net tangible assets should be of at least rupees 3 crore. Okay, and out of that net tangible assets, maximum 50% should be in form of monetary assets. Okay, maximum 50% should be in the form of monetary, non-monetary, you must be knowing those classifications, etc. So maximum 50% should be in the form of monetary assets, and otherwise you should be having net tangible assets of at least rupees 3 crore. Ma'am, when, for which period? Wait, I'll tell you that. Okay, first condition, net tangible assets of at least rupees 3 crore. Similarly, average operating profits, average operational profits should be of at least rupees 15. Okay, should be at least rupees 15 crores, and your net worth should be at least rupees 1 crore. Okay, all the conditions must be fulfilled, and whatever figures we studied, 3 crore, 15 crore, 1 crore, etc., this should be fulfilled in each of the 3 preceding financial years. In each of the last 3 financial years of full 12 months each, you should be fulfilling these numbers. If yes, then okay, in the current year you can come up with an IPO. Yes, and the last one, suppose if your company has changed its name. Okay, suppose if your company has changed its name in the last 1 year. Okay, maybe earlier it used to call itself as XYZ AC remote company. Now it is calling itself as ABC electronics company, means it has expanded its scope only from a AC remote to other electronics also. Then at least 50% of the revenue. Okay, then at least in the last 1 year, at least 50% of the revenue should be from the new name activity. Okay, earlier it was only from AC remote. Now you have expanded your operations to other electronics also. So from other electronics, your revenue should be at least 50% of the total revenue. Basically, new नाम से जो revenue आ रहा है या new काम से जो revenue आ रहा है, that should have accounted for more than or at least 50% of the total revenue. Are you clear with this? Yes. So these are the basic 4 conditions that you need to fulfill if you want to come up with an IPO. Yes, if you are not able to fulfill, okay, if you are not able to fulfill, then also they have given you certain conditions under regulation number 6.2. Let's see what are these conditions. If you want to come up with an IPO, still if you want to, even if you're not able to fulfill the conditions, still if you want to come up with an IPO, you can opt for book building process. Okay, you can opt for what? You can opt for book building process. Ma'am, what do you mean by book building process? So book building process is basically such a process where the underwriter, you must have heard about underwriter, right? Where the underwriter is trying to come up with an IPO and underwriter is not sure that at what price should we float our shares or at what price should we issue our shares to the general public. So it is trying to determine, okay, by inviting bids from the general public, it will try to determine that what price is the public ready or willing to pay for the issue price. So that is called as book building process. Maximum companies go with this book building process only. Okay, and in that at least 75% of the offer should be done to qualified institutional buyers. That is by way of qualified institutional placement. Qualified institutional buyers are big buyers. Okay, 75% should go to them. 25% will go to other retail and non-institutional buyers, right? And suppose if you are not able to get the subscription from the public, okay, if you are not able to get the subscription from the public, or if you are not able to allot 75% to the QIBs, they are also not interested in your company, then in that case, please refund back full money and the IPO is cancelled. Are you clear with this? Yes. So either regulation 6.1 is to be fulfilled or regulation number 6.2 is required to be fulfilled if you want to come up with an IPO. And last one note is there, if issuer had issued superior rights, SR, superior rights shares, means where they have got extra voting rights, where the shares are having extra voting rights, if it has issued to its promoters or its founders, then issuer can come up with an IPO, but only subject to certain conditions. Okay, the conditions are not very important, so I am not mentioning it here. But if at all the company had already, see, when the company was unlisted, at that time also the company can issue shares. Now, it will have to issue shares to its promoters, founders, etc. So, if we had given them some extra voting rights shares, so now when you are coming up with an IPO, you are required to fulfill certain conditions. Very clear with this? Okay. Okay, now if regulation 6.1 or regulation 6.2 is fulfilled, then we know that, okay, you can at least come up with an IPO, right? Now, apart from that, what are the other conditions? Okay, what are the other conditions that we are required to fulfill? Very simple, not really very important, but just read it once. What are the other conditions that we are required to fulfill? So wherever now that IPO is going to come, your securities are going to get listed on the recognized stock exchanges like NSE, BSE, please take approval from them. Okay, first point, please take in principle approval from the stock exchange that can we get ourselves listed. Second one, enter into an agreement with the depositories. Okay, for DMAT, because now when you are going to issue shares to your shareholders, that is going to be in DMAT form only. So enter into an agreement with them, NSDL, CDSL, whatever. Okay, whatever are the existing holdings of the promoters. Okay, whatever are the existing holding of the promoters, make sure that that is in DMAT form. If you had issued the shares in physical form, make sure that that is converted into DMAT form. If existing, you have issued any partly paid up shares, make sure that it is fully paid up. Okay, if they are not paying, please forfeit the shares. But we do not want any partly paid shares left in the company. Right? Acha. Next one. Okay, I am leaving this point for the timing. Okay, I'm just going to the last point, then I'll come back to that. and whatever amount you are now going to raise from your general public, okay, you're going to ask money from the public na, for which you will be allotting the shares. So whatever amount you are going to ask from the public, out of that maximum 25% can be used for working capital purpose. Means you should not be raising money for what? You should not be raising money for like maximum money for working capital. Maximum money should be coming for some capital expenditure, for some important activity, for a new project, for a new asset, etc. Okay, maximum 25%. Maximum, did I say 20%? Maximum 25% can be used for general corporate purpose. General corporate purposes, regular expenses, working capital, admin expenses and all those. But majority of it should be used for some main purpose, some crucial purpose for which you are coming up with an IP, right? And the last point says, like the second last one in your notes, second last point says that please make sure that, suppose, let's say my company had decided that if my IPO is successful, I will start a new factory unit. Okay, for which I need a capital investment of, let's say, 100 crore rupees, and for which I'm coming up with an IPO. But what if your IPO fails? Possible, na? You did not get the minimum subscription, people are not interested in your company, etc., etc. Then in that case, they are telling that please don't rely only on IPO. Okay, please make firm arrangement of finance. Please make firm arrangement of finance of 75%. Whatever you were going to raise from the general public, multiplied by 75%, please make it from some, please make arrangement of those many funds from some other means. Either a bank loan should be approved, or a bank guarantee should be there, or someone else is ready to give you 75% of your offer. Means you are not relying. See, the company's future should not rely only on the IPO. Are you able to understand this? Yes. So these conditions, these basic conditions must be fulfilled if you want to come up with an IPO. Understanding this? I hope I am very, very clear till here, everyone. General conditions are done, and now this is an additional point, additional condition for offer for sale. Okay, now let's say if there are some existing shareholders, pre-issue shareholding in the company, promoters holding in the company, if they want to also offer their shares, means promoters, etc., if they want to exit from the company, then that can be done, provided their shares are fully paid up. Okay, provided their shares are fully paid up, and those shares have been held at least for a period of last 1 year. Okay, means those people should be there in the company at least for the last 1 year, and those shares must be fully paid. Then only offer for sale can be done. See, one is we are issuing fresh shares. Okay, one is we are issuing our fresh shares, that is we are increasing our share capital, and another one is existing people want to exit from the company and they want to offer their shares. Are you clear with this? Yes. And then after that, next one, issue of convertible debt instruments. I hope you understand CDI, convertible debt instruments. Yes, convertible debt instruments means, let's say, convertible debentures. Okay, convertible securities, where what is going to happen in case of convertible securities? As of now, we will be issuing them the debentures, okay, on which we are going to pay them the rate of interest after some number of years as per the agreement. After some number of years, their debentures are going to get converted into equity shares. So we are talking about that. So now if any company wants to issue these convertible securities, etc., this can be done even without an IPO. Like this can be done even before listing your equity shares. Okay, so this can be done even without prior public issue and listing. But yes, there should be no default in payment of interest and repayment of principal for more than 6 months. You should not have defaulted with them. See, if you are defaulting, that again shows that you do not have the capacity to pay the interest or to repay the principal amount, etc. Then in that case, you cannot issue. You cannot come up with issue of convertible debenture instruments, etc. Let's say earlier you had taken some loan, or let's say earlier you had borrowed some money, etc., and you had failed in repayment of its interest or principal, etc. So if that default should not be there for a period of more than 6 months. If there, then you cannot issue the convertible debt instrument. Okay, and few additional conditions if you want to come up with this CDI issue. So you will have to obtain credit rating from any credit rating agency, example CRISIL, etc. From any credit rating agency, you will have to take out your credit rating, what is your credit score, which shows how well you have been doing the payments, repayments till now. Okay, then you will have to appoint one debenture trustee. This you must have done in your issue of debentures chapter earlier in your foundation or intermediate. Debenture trustee is one person who is acting on behalf of all the debenture holders. Then you will have to create sinking fund, debenture redemption reserve. Remember? Yes, and you will have to provide for redemption terms, that in how much time it is going to be redeemed or how much time it will be converted, etc. So that everything is clear, when we are issuing the CD. Manageable till here? Yes. Okay. Then after that, last few more points, 4 to 5 more points under your IPO. Next one, here we are talking about promoter's contribution. Okay, promoter, that first person, the idea giver, that person who floated the company. Okay, the person who floated the company. So now they are telling that, boss, we are inviting public. We know that we are inviting public. Okay. In that case, you don't leave the company and go. Okay, it should not happen that all the promoters are exiting the company. That should not happen, right? So promoters must hold at least 20% of the post-issue capital. Okay, whatever is your new share capital after this IPO, multiplied by 20%, that should be held by whom? That should be held by the promoters. Okay, this requirement, they should be holding 20% as on which day? At least one day prior to opening of the issue. Means the day when you are going to open the issue for the general public, one day before, promoters should be holding at least how much percent? At least 20%. Yes, and suppose if they are yet to purchase some shares, then their money, their contribution should be kept in a separate bank account. Okay, separate escrow account, the money should be kept so that that money can be utilized only for purchasing the shares. Right? And if the promoter's contribution is more than 100 crore, means the issue size is so big or the post-issue capital is going to be so big that at least 20% comes to more than 100 crore. And if the IPO is for partly paid shares, means when we are issuing the shares to the public, that is for partly paid shares, then promoters have to make sure, see how much was their contribution. If that is more than 100 crore, we are telling them that you please bring at least 100 crore now. Later, balance amount you bring as in when we do call from the general public. Okay, let's say for example, promoter's contribution is 150 crore. So what are we telling to the promoters? Okay, we understand that this is a big amount, but make sure that you deposit at least how much? Make sure that you deposit at least 100 crores now. Okay, balance 50 crores you give up as in when we do pro rata calls from the general public. So in short, promoters should be holding 20% of the post-issue capital. Okay, if they are not holding, then they should promise us to hold 20%. Okay, for that they will have to give the money to the company. That money will be deposited in a separate escrow account. This requirement should be fulfilled at least one day prior to opening of the issue. If their contribution is more than 100 crore, then please make sure that you take at least 100 crore from them now itself, and balance amount, because IPO is for partly paid shares, so even they will say na that we will pay partly, but we will tell them no, you will have to pay 100 crores now, and balance amount you pay on pro rata before making the call to the general public. Are you clear with this? Yes. Okay. Then after that, whatever is this promoter's contribution, okay, whatever is this promoter's, we are talking about the lock-in period now. So promoters, they were holding at least 20%, they are required to hold at least 20% of the post-issue capital. So now, whatever, let's say there is some promoter who is holding exactly 20%. Okay, so that he has to hold for a period of at least 18 months, 1.5 years, 18 months from the date of allotment. That is compulsory, you cannot exit. Okay, but if the money which was given by the promoter, that is now kept with the company, and company is going to use it for capital expenditure purpose, So can we say company will need time to give the money back to the promoters? So in that case, instead of 18 months, the minimum lock-in period is going to be 3 years. Okay, so promoters will have to keep their money with the company for a period of at least 3 years. The company is planning to utilize it for capital expenditure because the horizon period is more, right? The gestation period will be more there. Otherwise, normally 18 months. 18 months is the lock-in period. Okay, but if the promoter is holding something in excess of minimum promoter's contribution, minimum promoter's contribution was 20%. Let's say they are holding 30%, for example, or let's say they are holding 22%. Then that extra, for that, the lock-in period is going to be of 6 months. But if the money is utilized for capital expenditure, instead of 6 months, it will become 1 year. Double. Basically, 18 months was 1.5 years. So 1.5 went to 3 years. Here 6 months went to 1 year. Are you clear with this? This lock-in period is applicable for whom? This lock-in period is applicable for promoter's contribution. Okay, now what about other than promoter's contribution? What about other founders? What about QIBs, etc.? So for them, the lock-in period is going to be of 6 months. Like mutual fund companies, anchor investors, etc. Whenever they are also big buyers in the company, right? So it should not happen that first they are buying and immediately as soon as the shares get listed, they should exit the company. No, it will affect the share price a lot. So they are given a lock-in period of 6 months. So minimum promoter's contribution 18 months. Promoter's contribution in excess of minimum contribution is going to be 6 months, and other people's lock-in period is going to be of 6 months. Are you clear with this? Yes. And now, yes, one good thing that they have provided here is, now if promoter is holding some shares, okay, and if he wants to exit the company before this period, before this 18 months, 6 months, etc., can they give it to other promoters? Answer is yes. Okay, they can transfer it to other promoters, but they cannot transfer it to any other person, right? Now. But when they are transferring it to other promoters, lock-in condition is also required to be fulfilled by the other promoters. Okay, similarly, there are two anchor investors. Okay, one anchor investor wants to exit the company. Can he sell it to another anchor investor? Answer is yes. So lock-in period, balance lock-in period requirement is to be fulfilled by the other anchor investor. Are you clear with this? That is written here in green in the bracket. Manageable till here. Yes, this was talking about your lock-in restrictions. Okay, so let's go ahead to the next part. That is when you are filing the offer document. Okay, when you are filing the draft offer document and when you are filing the final offer document, at that time, what all things are required to be disclosed, to whom all are we supposed to submit that offer document? Let's try to understand that. So first of all the material disclosures about the company, about the issue, that must be made in both the document, that is the draft offer document and the final offer document. Okay, then we have to file this. We'll have to file this with many authorities. Okay, the most important authority here is going to be the SEBI, then it is going to be the stock exchanges, then it is going to be the ROC. And then finally, we are going to make it available to the general public. So see, those points are given here in a particular sequence. Issuer shall file 3 copies of the draft document with the SEBI. Then file the draft document with the stock exchanges. That is, you are filing 3 copies with the SEBI and one copy with the relevant stock exchange where your securities are going to be listed. If SEBI tells you that you are required to do certain changes in this draft offer document, please make sure that you do the same. After doing the changes, whatever is your fresh draft offer document or revised draft offer document, please go and file it with the SEBI. And at this level, finally, the SEBI is going to give you the approval. Once the approval is given, then your offer document gets draft offer document gets converted into offer document that you have to again go and file it with the same 3 authorities and then make it available to the general public. Are you clear with this? So basically, we have to disclose all the material facts. Okay, we have to disclose all the material facts in it. Secondly, we have to file it with the SEBI, we have to file it with the stock exchange, we have to file it with the ROC, and we have to make it available for the general public. Manageable till here? Yes. Okay. Then after that, going to the second last part. Okay, going to the second last part of your IPO thing, that is pricing. Okay, now what about the price at which the shares should be issued to the public in case of IPO? Let's try to understand that. Okay, so whatever is your pricing, first of all, it has to be mentioned. Okay, it will be mentioned in the offer document. Okay, now there can be two types of pricings applicable. One is fixed price issue. Okay, one is fixed price issue, that is, okay, let's say at 100 rupees my IPO is going to come. Okay, so in case of, there are two types of issue. One is fixed price issue, where you are more or less sure about your IPO success. Okay, and the next one is your book building issue that we had discussed, where the underwriter was trying to assess, was trying to take the price from the public, that what price is the public willing to pay for our company's share. So if we are going for a fixed price issue, then either you can mention a fixed price or you can mention a price band, a range. Price band is nothing but a range. Okay, but if you are going for book building issue, then definitely you cannot mention a fixed price there. There you will mention a floor price, lowest. Okay, lowest price that you will mention, or you will mention a price band. Price band is nothing but the range again. Okay, so basically in case of fixed price, generally it is one price or a range of price. In case of book building, it is the floor price and a or a price band. Right, now in this case, just try to understand, whenever we are mentioning about price band, in this case, in case of book building we are talking, cap on the price band is less than or equal to 120% of the floor price. Okay, and minimum, this is the upper cap. Okay, means that can go up to 120% of the floor price, and minimum cap shall be at least 105% of the floor price. Okay, so let's say if your floor price is 100, then in your price band, the lower cap will be 105 and upper cap is going to be 120. Are you clear with this? This is how you are required to determine the price band here. And now, whatever is the price that you have decided, ma'am, can we give discount on this price to any category of investors? So they are telling to retail, that is to people like us who do an application of maximum, who apply for shares of maximum 2 lakh rupees. Okay, to retail individual investors and to employees, we can give a maximum 10% discount. And in case of book building issue, okay, there the price offered to anchor investors, big investors, shall not be lower as compared to others. Okay, so basically to retail and to employees we can give 10% discount, and no discount should be given basically to anchor investors. Please be sure, because in case of book building issue, maximum shares go to anchor investors only, maximum shares go to QIB only. So please make sure that you don't give any discount to them. Right, and the last few conditions for issue of securities, etc. Whenever you are coming up with an issue, make sure that it is open for a period of at least 3 working days. Okay, public should get a time period of at least 3 working days to subscribe to your issue. Right, minimum subscription that you should be receiving from the public is equal to 90% of the offer. Okay, if not received, please refund back the money within 4 days from the date of close of the offer. Whenever the offer closes, within 4 days, you will come to know, when the offer closes, you will come to know that whether you have received 90% or not. If not received, refund back the entire money. If refund is not done within 4 days, pay along with interest at the rate of 15%. Okay, pay along with interest at the rate of 15%. Now, period of subscription is going to be minimum 3 days. It can go up to maximum 10 days also, but nowadays they keep it for 3 to 4 days maximum. Yes, minimum application size, that is, if I want to apply minimum for some number of shares, I should commit somewhere between 10,000 rupees to 15,000. Normally it is somewhere within 15,000 rupees, near 15,000 rupees only. That is, if let's say I want to purchase some shares, then I will have to purchase in some lots. Okay, maybe I cannot, I will have to subscribe for minimum some number of shares. So that has to be in the range of rupees 10,000 to 15,000, and in that also minimum amount that I have to pay upfront is equal to 25%. Nowadays companies take full 100%. Okay, but as per SEBI regulations, you will have to pay at least 25%. And since this is an IPO, okay, since this is an IPO, minimum number of public allottees should be 1,000. There should be at least 1,000 subscribers. Okay, 90% is in the value. 90% is in the value, and minimum 1,000 shareholders should be there who are willing to purchase your shares. Okay. Similarly, retail individual investors can apply for maximum. See, minimum was 10,000 to 15,000. They can apply for maximum rupees 2 lakhs, and employees can apply for maximum rupees 5 lakhs. Okay, so these are some numbers, these are some figures which are relevant in case of IPO. Important thing here is issue should be open for a period of at least 3 working days. Maximum it can go is up to 10 days. For a successful IPO, minimum subscription is equal to 90%. If not, please refund it back within 4 days from the close of the offer. If not refunded within 4 days, please pay interest to the public at the rate of 15%. You cannot play with their money. And anyway, this money is deposited in a separate bank account, in a separate escrow account, right? Then minimum application that we can make is somewhere between 10,000 to 15,000. Maximum application that can be made by retail people is equal to 2 lakh rupees, and for employees is equal to 5 lakh rupees. Minimum number of people who should be coming, minimum allottees who should be interested in your company is equal to rupees 1 lakh. Are you clear with this? So these are some terms and conditions which are required to be fulfilled. Manageable till here? Yes. And last point, okay, after this your FPO is starting. Last point here is the concept of green shoe option. Okay, green shoe option is, this can be done for both IPO also as well as for FPO. Okay, I'm not going to repeat it again for FPO. This concept is common for IPO as well as FPO. So basically, green shoe option, the name comes from a company called as Green Shoe Company. Okay, Green Shoe Company, not an Indian company, it is a foreign company. Back in 19 some year, they had come up with an IPO, and at that time they had applied, they tried this concept in their company's IPO, and this went successful. After that, even SEBI introduced it, and the concept itself was called as green shoe option. So green shoe option is basically a method which is used by a person called as stabilizing agent. Okay, this stabilizing agent is nothing but your underwriter, merchant banker, same person, just that he has been given a new name called as stabilizing agent. Okay, stabilizing agent, the work of stabilizing agent is to stabilize the prices. Okay, his work is to do what? His work is to do stabilization of prices. Now, whenever an IPO comes, you must have seen now, some IPOs are in great demand. Okay, so the prices go up. Okay, whereas some IPOs do not show that great demand. So as soon as the shares get listed, the prices come down drastically. So can we say if the prices come down drastically, it causes loss to the existing investors in the company. So that they don't suffer this losses, there is a mechanism called as green shoe mechanism, which can be used by a stabilizing agent, and he can manage the prices. He can stabilize the prices for 30 days. Okay, once the shares are listed, after that for 30 days. Now let's say immediately after listing, there is a case of oversubscription. Okay, immediately after listing, we come to know that the demand is very high. Can we say when the demand is very high, the price also goes on increasing? Normal economics. So here, what will the stabilizing agent do? Stabilizing agent will borrow. Okay, it will borrow some shares. Ma'am, how much? Maximum 15% shares. Okay, it will borrow some shares from the promoters of the company. It will take the shares from the promoters. It will issue to the investors. Already there was high demand in the market. So for them, it will issue the shares. Can we say if the demand was more, and now if we are matching with the supply also, then the prices will stabilize there. So the price gets stabilized. From whom have we borrowed the money? From whom have we borrowed the shares? We have borrowed the shares from the promoters. We have not purchased it, we have borrowed. Okay. Now, because of this, can we say as of now the prices get stabilized. Okay, now during the first 30 days period only, sometimes if the stabilizing agent feels that the scenario has gone reverse, that more and more people wants to now sell the shares. Okay, the demand is less for the shares and the supply, more people want to sell it, but there are less buyers. So in that case, can we say he will have a risk that the prices may go down? Now, if he has the risk that the prices will go down, what will he do? Then the stabilizing agent, he had already issued the shares to the investors. Now he will purchase it from the market. Okay, he will purchase the shares. Means can we say he's creating a demand for the shares? He's purchasing the shares from the market. And what will he do? Now the market prices will be stabilized because he has purchased, because he has created a demand. Prices will no more fall now. So now whatever shares he has purchased from the market, he will give it to the promoters. Remember, he had borrowed it from the promoters. Now he will return it back to the promoters. So whenever he feels the demand is more, he will do the left hand side. Whenever he feels the demand is less, he will do the right hand side. And this he can do it on regular basis for a period of how many days? For a period of 30 days. Are you clear with this? Now, for doing all these things, can we say it will need money? Stabilizing agent will need money. When it is buying from the market, when it is selling to the market, there will be cash involved. So all these transactions will be done using a special bank account. Okay. Now, more or less the transactions will be settled. But can we say the transactions will be settled at different prices? You borrowed it from the promoters at some other rate. You sold it to the market at some other rate. You bought it from the market at some other rate. So if at all there is some money, there are some profits left, okay, by doing this, then that will be transferred to the IEPF account. I hope you know the IEPF account, Investor Education and Protection Fund account. Are you clear with this? Yes. So stabilizing agent is just trying, legally, he is just trying to manage the prices for a period of first 30. This concept is called as what? This concept is called as green shoe option or price stabilization mechanism. Are you clear with this, everyone? Yes. Okay. So this was all about your IPO provisions. Okay, all about your IPO provisions from the SEBI ICDR regulations. If this much was more or less manageable for you, FPO is going to be a cakewalk. Okay, FPO is going to be a cakewalk. Don't worry about it at all, because majority things in FPO is going to be similar to your IPO. Can we start, everyone? Yes. Now, in case of FPO, again, whatever requirements we are going to study, that is required to be fulfilled on 2 dates. Same, on the date of filing the draft offer document to the SEBI and on the date of filing the final offer document to the ROC. On both of these dates, the following conditions must be fulfilled. Then, who is not eligible to make an IPO? Who is not eligible to make an FPO? Same, the people who are debarred, promoter, directors, fugitive offenders, same provisions that we had studied, same as the IPO. Okay, same as IPO, same conditions are applicable here also. Even the first condition was same. Okay, then next one is a little different one, eligibility requirements. Do you recollect there we had studied net tangible assets, operating, average operating profits and net worth, etc. Here the conditions are changing. Okay, now here again, either regulation number 1031 or regulation number 1032, any one can be fulfilled. Okay, first we will try for regulation number 1031. What does 1031 says? Now you are eligible. See, you have already done IPO now, right? But see, you are doing FPO now. So means your company is already a listed company. So those net tangible conditions are now again not required to be fulfilled. Now they are just putting one condition, that suppose if you have done name change, only that last one condition. If you have done name change in the last 1 year, then make sure that at least 50% of the revenue is coming from the new name activity. Okay, if this condition gets fulfilled, very good, you can come up with a FPO, no problem. But if this condition is not getting fulfilled, then sub-regulation number 2 conditions must be fulfilled. That is, you will have to go with book building process, you will have to issue 75% to the QIBs, and if not done, please refund the entire. Manageable, everyone? Yes. Okay. Then after that there were certain general conditions, that is, you have to take the permission from the stock exchange where further issue of securities will be done. Enter into an agreement with the depositories, because now new shares will be in demat form. Okay. Then if you are having any partly paid up shares, please make sure that those are fully paid up or those get forfeited. Please don't rely only on FPO. Please make firm arrangement for how much percent? 75% of the offer value. And whatever you are raising, maximum 25% can be used for working capital. Rest has to be used for some capital expenditure purpose. Right? Same condition. Yes. And then again, offer for sale. If existing, if we are not issuing new shares, but we are doing an offer for sale, that is existing shareholders are exiting from the company and we are bringing new people. Okay, no problem. Only two conditions to be fulfilled. First of all, these shares must be held for a period of at least 1 year, and secondly, these shares must be fully paid up. Same condition, same as IPO condition. Right? Then again, convertible debt instruments, convertible debentures can be issued. Yes, provided there should be no default in repayment of interest or principal for a period of more than 6 months. That same condition is there. And here, this is important. FPO of CDI and warrants can be done only if equity is already listed. Do you recollect when we were doing it in IPO at that time? At that time, when you are doing IPO of convertible debentures, earlier listing of equity shares was not mandatory, but when you are doing FPO of convertible debentures, at that time you should already be a listed equity company. Yes, and additional conditions remain the same as IPO. That is, if you are issuing debentures, please make sure that you obtain the credit rating, you appoint the debenture trustee, you create promoters contribution is also same as IPO. Okay, in case of FPO, also promoters contribution should be at least 20% of the post issue. Means whatever is going to be your new capital multiplied by 20% should be held by the promoters. They have to fulfill this at least 1 day prior to opening of the issue. Whatever amount of shares they are required to purchase now, for that money should be kept in a separate escrow account. If their contribution was more than rupees 100 crore, and if we are issuing partly paid up shares, please make sure that you take at least 100 crores from them now, and balance amount you can take it later on pro rata basis. Same point that we had done. Yes, same. Then after that, this one is the new one. Okay, this one is a different one. Requirement of promoters contribution is not applicable. That is, this minimum requirement, minimum capital requirement is not applicable if company does not have an identifiable promoter. No identifiable promoter, no promoter contribution. Right? Acha. If the shares are frequently traded on stock exchange for at least 3 years, if for the last year, already IPO was done, and for the last 3 years the shares are normally traded, then why do we need promoters minimum contribution? No problem. Remove. Yes. Then the company has addressed at least 95% of the investors' complaint. Means it is a compliant company. Okay, it is a compliant company. It is a good company. No problem. Okay. And last, if the issuer has been complying the LODR regulations for the last 3 years, again the company is a compliant company, then the promoters again need not fulfill the requirement of having the minimum promoters contribution. Okay, what were the 4 pointers? First one, it does not have an identifiable promoter. Next one, at least 95% of the complaints have been resolved. Next one, if the shares are frequently traded for last 3 years and the company has been complying with the SEBI LODR regulations for the last 3 years. Manageable? Yes. Okay. Promoters contribution lock-in period remains the same. Minimum promoters contribution, if applicable, 18 months. If done for capital expenditure, 3 years. Excessive holding by promoter in excess of minimum contribution, it is going to be 6 months. If used for capital expenditure, then 1 year. Same provision. Okay, can promoter transfer it to another promoter? Yes, but the lock-in requirement is required to be fulfilled by the new person. And then this point is a different point. Promoters, remember they were lending shares to the stabilizing agent during those first 30 days under green shoe option. So for that, lock-in period is not applicable, because remember the promoter was lending it to the stabilizing agent was selling it to the investors, etc. So lock-in period is not applicable for those many number of days till the time the promoters are returned back their shares. Logical? Okay. Then this one is again same. I am not doing this. Same as IPO. Disclosure. All the material disclosure should be made in the draft offer document and the offer document. We will have to file it with the SEBI, Stock Exchange, ROC and the general public. Same, ditto point. Yes. Okay. Pricing point. Pricing point is also the same. Pricing point is also the same as the IPO. Okay, that is when we are doing fixed price issue, we have to either mention the fixed price or you can give a price range. Okay, when you're going with book building issue, then in that case you have to give a floor price or a price band. When you're giving a price band, in that case 105% to 120% of the floor price, that is going to be the cap. Can we give discount? So to retail and employees we can give 10%, but to anchor investors we cannot give any discount. Then next, issuance condition. Again, same as IPO. FPO offer should also be open for a period of 3 working days. Yes, minimum application size 10,000 to 15,000. 90% is the minimum subscription. If you don't get 90% money, please return back the money within a time period of 4 days from the close of offer. If not returned, pay interest also at the rate of 15%. Minimum public allotee should be 1,000. Same. Yes. Okay. And last point, different point. Okay, important. Now, when you are coming up with an FPO, okay, when you are coming up with an FPO and you were able to fulfill the requirement of regulation 1031. Ma'am, what was 1031? I'll show it to you. Do you recollect basic condition for FPO? This one, only one condition. If there was a name change during the last 1 year, at least 50% revenue should be from new name activity. If fulfilled this, well and good. If not, then we will have to go by this book building process and 75% to QIB. So they have given an allocation ratio. Okay, they have given an allocation ratio. Check what is the allocation ratio. For regulation number 1031, that is only name change point. Okay, if name change fulfilled, then in that case, at least 35% should be allocated. Whatever is your issue size, at least 35% should go to retail individual investors, people like you and me. Okay, at least 15% should go to non-institutional investors, means bigger than RII. Non-institutional investors is people bigger than RII. And maximum 50% should go to QIB, and in that also 5% should go to mutual fund company. So 50% maximum to QIBs, rest to general public. Right? But if you are not able to fulfill that, that is if you are going by book building process and 75% to QIB, etc., then at least 75% to QIB, this we have already studied, and balance 25, that is 10% to RII, 15% to NII. This should be the allocation ratio in case of manageable. Yes. And last, that is your miscellaneous provisions, green shoe option. This I told you earlier also. Just like you exercise green shoe, you were allowed, it was optional. You can do it for IPO also and you can do it for FPO. Manageable till here. Yes, so these are, I have taken all the important points. Okay, I have not taken all. Okay, I have not covered all, but I have taken all the important points which is relevant from your exam point of view. At least do this much for your SEBI ICDR regulation, and in a time span of around 1 hour. Okay, we were able to summarize it and bring it down to all the important points. Okay, these notes again, these are available. If you have taken my lectures, then these are already provided to you in the drive. If you have not taken the lectures, then in that case, for this study, I have put the notes on my website, that is arpitatulsyan.com, in the free notes section. Manageable, everyone? Okay, thank you so much.